Good afternoon, everyone. Glad to have you back at our third economic update on the markets. I'm Terry HORAN, and I'm with a great team of people here today who I will introduce in just a second. But first, I want to remind you that there's an old African proverb that says, if you want to go fast, go alone. If you want to go far, go together. I just want to assure you that we at HORAN are here for you so that we can go far and go together. And we will continue to do these Friday updates at 2 o'clock, including next week at Good Friday, until we pass through this terrible uncertainty that we're dealing with. Let me first update you with regards to details on HORAN. We're open, but we've asked our staff to work from home through the governor's new order of May 1st. So that leaves a very small staff, maybe 3 or 4 people in the office each day, working and practicing social distancing. But accessibility is our top priority, and we'll continue to be diligent and proactive with our communications with you. For help for you for the COVID-19 resources, both government, wealth management, and employee benefits, we have a landing page on the HORAN website. At HORAN, we focus on 27 fundamentals throughout the year that align with our core values. This week's is do the right thing always. And that means that we always tell the truth no matter the consequences. We are impeccable with our word, and if we make a mistake, we'll own up to it. And we even do that when no one's looking. So today we've been fielding, as in the past week, many calls from you unsure what actions today to take. And we're going to give you some economic outlook, the reactions to Washington and what it means for you, and some investment ideas for both our younger and our older clients. I'm in the room here with Paul Carl, with 33 years of industry experience, 8 of which with the Department of Labor. Greg Hornschmeyer has over 30 years in the business, providing insurance funding for complex needs in the area of business transactions and estate planning. David Templeton, CFA, with 30 years of experience in the financial services industry, retail banking, corporate lending, and investment portfolio management. Mike Napier is on the line with us, who's a CFP and has crafted detailed financial plans and coordinated investment strategies. And the new kid on the block with us today is Matt Antonucci. He is with HORAN Capital Advisors. He's a CFA and responsible for meeting the investment and planning needs of HORAN Capital Advisors clientele. And with a name like Antonucci, I can assure you that he makes a terrific spaghetti sauce. Anyway, David, why don't you lead us off?
Okay, thanks, Terry. Just as we did last week's presentation, want to cover the market for the week, and this is through Thursday, the last 5 trading days. And we mentioned this last week that it would not surprise us to see a pullback in the market. We were up low double digits on the S&P 500 through Friday last week. This week, the market through Thursday is down about 3.75%. As we entered the room today, we're down another 2 to 2.5%. So this is not surprising to us to see this market pull back. To take on the next slide, taking a longer term view of the market, year to date, the market is down 21.79%. This is through yesterday's market close. It does remain up about 12.9% from the bottom that was reached about 2 weeks ago. We do think there's, given some of the economic data that's come out, jobless claims were about 6.6 million on individuals on Thursday. The non-farm payrolls this morning down 750,000, exceeded expectations. We think the market is going to continue to need to digest some of the economic data the weaker economic data that we're seeing come out, and that's one reason the market has turned lower today. On the positive front, the market does continue to remain lower. We think there's opportunity for higher stock prices ahead. The big question becomes, and I'm going to have Matt cover this, what does a potential recovery look like? So Matt?
Thanks, David. So clearly we're in unprecedented times right now, but to help us answer the question of what a recovery might look like for us, we can use history as a guide and examine some of the forms or shapes that a recovery could take for us. So have a few charts to help us illustrate this. We're looking at slide 6 right now. In the top chart, we're looking at the S&P 500 during the peak of the financial crisis and its recovery thereafter. And this recovery we call is in the shape of a check mark or an L due to the steep drop and the subsequent impressive march higher after the low was made. The L-shaped recovery is a longer duration recovery, typically due to how deep the economic impact is, but while slower, the market's move higher is persistent and lasts for years. Below that, we have what we call the W-shaped recovery, where the time period we're looking at here is 2015 to 2016. We had a stronger dollar and oil prices that had collapsed earlier in the year to cause an earnings recession for S&P 500 companies. The markets dropped and traded sideways for nearly a year. But once it became clear that earnings were going to grow the following year, the market resumed higher. And the W recovery is usually short-lived with a clear line in the sand low where the market makes a low and then it rallies, retests that low, and then charges higher. So it's short-lived, but also volatile. So just a couple more charts on the next slide. The top chart, we're looking at the tech bubble, where market valuations became excessive and unsustainable. And this recovery represents a U-shape. Both the decline and the recovery took years to form. It's another long duration type recovery where the market takes time to find a low and then slowly builds higher over time. And finally, the bottom chart here on slide 7, we have my personal favorite, the V-shaped recovery. And we're showing you the analog of the 2018-2019 drop where the market sold off as a result of the Fed going quite aggressively and raising interest rates, where the market was not on the same page where the Fed saw the economy. And the Fed Chair Jay Powell famously made his comment that the Fed's balance sheet policy was on autopilot. This ended up being a V-shaped recovery. The V-shaped recovery is where a market issue is quickly resolved and a rally ensues, which results in new highs in just a matter of months. So in this case, it was the Fed backing off its interest rate hikes, and that was well received by the market. And it's important to note that the V-shape is quick on the downside as well as the upside. So as we show, recoveries can take many different shapes and lengths of times to regain their recent highs.
So the question becomes, what kind of recovery would we expect in the current situation? And we think because this is unprecedented, we think it's going to be a combination of two different recoveries. We do think some industries like retail, restaurants it's going to be more of a V-shaped recovery for those types of industries. When we get through this virus situation, those companies are going to hire back a substantial number of their employees, and they're going to get back up and running fairly quickly. We think there's other segments of the economy that are going to be more U-shaped in nature, like the airlines, hotels, travel. It's going to take a longer period of time for the demand to come back to those types of industries. If you put those two together, it's probably more, because of what we're seeing in some of the economic data, you put those two together, it's probably going to be on a combined basis, somewhat of an L-shaped recovery that we see, with pockets of some industries doing very well. And we're focused on that here at HORAN, looking at some of those industries that have been hit the hardest, financials, industrials, and the consumer discretionary, which would be the retail space. So, there's some places to be positioned, and we're being opportunistic to do that for client accounts.
David, just for fun, talk about the depth of the issues for Disney World and yet the opportunity for recovery once things get back going.
Right, and Disney World, that's a good example. They're in multiple businesses, so that will benefit them. They're actually doing well currently with the media space because of everybody sitting at home and watching TV. And now ESPN has been weak, but maybe the Pro Bowl draft will pick up some excitement there that's going to actually take place. But the travel industry might be weaker for them, and so the theme park business may be a slower startup for them.
Do you think? And the cruise business might be.
And the cruise business as well.
Well, charts LUV, I love this type of work here.
That's good, Terry.
Yeah, well, I was trying to work in W. I couldn't figure out how to do it. So we also have a slide on history of market declines. Is that Michael?
I'm here, Terry. So good afternoon, everyone. I'm in the beautiful Commonwealth of Kentucky.
My Might have to speak up
today.
just a little bit.
Okay, can you hear me better?
Yeah.
Okay, good. So good afternoon, everyone. The next couple of slides talks about staying to your plan, staying in your plan, not deviating, not thinking you're smarter than Wall Street and can time the market. So if you look at this particular slide, history of markets declines, it's very common to have dramatic downturns in the market. And so, and these 5 examples here have some of the worst declines we've had in the stock market. But if you pay attention to the last decline that Dave and Matt talked about on the right-hand side, the tech bubble, 10/9 of 07 to March 9th of 09, from the top of the market to the bottom of the market, the S&P was down roughly 57% at one time. And so 1 year after the bottom, one year after the bottom, you would have had an increase of roughly 72% in your portfolio. The second year after the decline is 18%, third year 6%, fourth year 15% increase, and the fifth year 23% increase in the market. So we don't know how much farther, if any, that we have in this decline, but history would say when the decline is over, we enjoy very positive returns on the most part on these market declines. If you want to hit back up to
go right ahead. I'm sorry.
If you want to back up one slide, we missed the slide there, Terry.
Oh, okay. How about there?
Okay, that's good.
Okay.
That's good. So, on a typical market decline, we've seen many types of declines. So, during the year, so a typical year, we have a decline of roughly 5%, roughly 3 times a year. And the last occurrence of this was August of 2019. 10% happens about once a year. We're used to about a 10% decline about once a year. 15% happens every 4 years, and a 20% decline or a bear market typically happens every 6 to 7 years in the market. And
Michael,
so it's again.
Right ahead.
So again, it's very common to have these dramatic downturns. And in the 2019 downturn, we had it was not quite 20% decline for the fourth quarter. It was a fourth quarter decline in 2019. We had a 9% decline in December of 2019, and 4% of that, if you remember, was Christmas Eve. So we had a 4% decline on Christmas Eve. And after Christmas happened in 2019, the market rallied and never looked back in the majority of 2019. So we've seen these downturns before. They happen on a regular basis. Yet, and the market always has corrected since then.
Michael, that was a great analysis, and I would like to add a little color to the particular one that went from March 6th of 1937 to 428 of 42, when the market just sort of quietly turned around. In April of 1942, there was really no reason economically for the market to turn around. Germany was still holding on to Libya. The British weren't sure they were going to be able to get it. We were trying to get our Navy back together from Pearl Harbor. We weren't sure that Russia was going to be able to hang on against Germany, but for some reason in April, public sentiment changed, and the market began to move again, and it moved quickly after that period. So as Dean Witter said, somewhere before June 1st, 1932, if you wait till the market starts climbing again, the real chance for gains have melted away. So it's a reason to stay in. David?
Well, that's a great point. And just like in the financial crisis, the market actually started recovering prior to the economy recovering. That actually started recovering when investors got confident the financial system was going to be taken care of, and the Fed kind of shored up the balance sheet of banks. We believe the market will start factoring in a better environment this time once we get some clarity about the virus flattening and opening up the country. And the market's will certainly anticipate that prior to the economy getting back to full steam.
Yeah.
So you need to be positioned for that recovery prior to the economy giving off positive signals.
Right. And I bet you're working hard on that, right? You and your team?
Yes, we are.
Thank you, Michael, for your input. I think we're going to turn to Paul at this point. Last week at this time, we were 2 hours from the signing of the CARES Act, and now we've got a week of information about it. And Paul, you're going to lead a discussion on what's in that bill, and so that everyone appreciates what opportunities persist.
I am, and thank you, Terry. So what we're going to talk about is the immediate impact for individuals via the CARES Act, and we'll start with this recovery rebate. You know, on one hand, it's getting a lot of airtime, and on the other hand, I don't feel like it can get enough airtime. So what is taking place here is every individual or family, two-person family, will be receiving a check or a direct deposit from the government, $1,200 or $2,400 respectively. Plus, if you have some children under age 17, you will have an extra $500 per child, up to 7 children. A lot of the examples that have been used have said, you know, a family of 4 is going to see $3,400. That's correct. That's the $2,400 plus 2 children at $500. But the fact of the matter is, it's up to 7 children. Now, this money is phased out based on income, and that starts, if you're single, it starts at about $75,000. If you are married, filing jointly, that income will be phased out starting at $150,000. What are they basing this on, right? So how does the government know how much money we're earning? Well, it's your tax return. So they're going to look for your 2019 tax return, and if it's filed, that's what they're going to use. If not, they will use your 2018 tax return. So here's a key point right now. Tax returns are not due until July 15th. That's been extended. If your income was lower in 2019 versus 2018, you may want to get that 2019 income tax return filed sooner, especially if you start to hit those phase-out areas.
And Paul, that true too, if you had a child in 20?
You will also get.
And if you, yes, so if you have a child in 20, so if you're pregnant right now and that baby's born before December 31st, you will have $500 as well.
Hey, just one comment on it. Not that we're accountants and you have to check with your accountant, but most states have pushed back the due date for the taxes to align them with the federal government. However, some states are not waiving the interest charge. For example, Kentucky, they've waived the penalty, but they're still charging you 2% for every 30 days that your payment is late or is missed past April 15th. So if you're a Kentucky resident, you're going to want to check with your accountant if that's, just to be certain that that's, to see if that has application to you.
Paul, I must comment on this. I do have 7 children, but I'm still kind of glad they're all over the age of 17 at this point, even though I'm missing out on some money.
Well, yeah, exactly. So that's, I'm missing out as well. I don't have 7, but I've got quite a few. One other note, anyone that's receiving Social Security benefits and maybe does not file a tax return, there was some misinformation initially communicated, and the indications are that Social Security recipients will receive these funds automatically, and not to worry about it. There was some misinformation about a form needing to be completed and sent to the IRS. That is not the case. These funds will be sent or direct deposited directly to Social Security recipients as well. So on the next slide, we're getting into some of the retirement-related pieces of the CARES Act. First of all, required minimum distributions are waived for 2020. So if you were required to take a required minimum distribution anytime in 2020, that is waived for this year. If you've already taken the required minimum distribution, you may redeposit that by December 31st of 2020 and get, in effect, the offsetting credit, so no tax effect. And the other item that I wanted to highlight on this is this does include inherited IRAs. So that's a nice little bonus there. As far as retirement plans, first, if you have an existing loan out of your current retirement plan, say through a 401k or a 403b, those existing loan payments can be suspended for up to 1 year. Plan sponsors, no extra interest and no penalty. It's not going to go into default and become a taxable event, which is good. In addition to that, the CARES Act specifically, if you have a COVID-19 related event, new loans can be taken from a retirement plan in amounts of 100% of your vested account balance up to $100,000. This is double the normal provisions for retirement plans. I would like to note that a plan sponsor, your employer, would need to adopt provisions to allow for that in order for it to occur. But there is a fast track available for that to happen.
Paul, to be clear on that, it's our impression as an employer that we don't have to formally make the amendment before a request comes in from the employee. We have a couple of years, I think, to make that adoption, COVID, and you can make a COVID adoption and not open it up for all loans and all hardship withdrawals.
Yeah. Terry, that is correct. So the functionality of it can happen right away. The actual amendment to the plan document can wait until 2022, I believe it is.
And we can depend, as an employer, we can depend on the word of the employee. We don't have to go into a lot of detail and understanding the issue.
Exactly. Certification from the employee requesting the loan, or this next piece, the penalty-free withdrawal, is adequate. There's no additional proof that's needed. So this next slide is discussing the penalty-free withdrawals. This may look a little bit more attractive in the long run, and I'll explain why in a minute. But first of all, an individual has to incur a COVID-19 related event. This is applicable for certain types of retirement plans and IRAs. Those retirement plans are the 401k, 403b, governmental 457b. They do not extend to defined benefit plans. There is a waiver of the 10% penalty for this in-service withdrawal. That is important for anyone younger than age 59.5, especially. Now, income tax on the withdrawal will still apply, but here's the neat part with this. First of all, the tax is payable over a 3-year period, or even better, once the economic recovery takes place and we end up with one of these, a V, or I was going to say,
This has Matt.
love.
Love.
I like the love.
Yeah.
Anyway, the person taking the withdrawal can repay the amount withdrawn within 3 years and avoid the taxable event altogether. What would be nice about this particular piece is you can dip into your retirement savings and then put it back and not do too much damage to it. Along with the loan provisions that we talked about, employers must make an adoption of this, and the record keepers will need some time to implement. I can tell you we've been in contact with probably a dozen record keepers, and at least half of them are really fast tracking this. A couple of them even have it up and running. And then to Terry's point before, the actual plan amendment doesn't need to occur until a couple years down the road.
Well, maybe you saw too yesterday that president of Empower, which is one of the companies we do business with on the retirement plan side, was on the television and on CNBC, as a matter of fact, and he had some interesting stats about their particular business.
He did, Terry. He had some incredible stats, and over 50, maybe as many as 60% of their participant pool, and they cover, I think, about 9.5 to 10 million participants nationwide. Over 50 or 60% have accessed their account in some form or fashion via the phone app, the call center, and only 1% have taken an action that would basically sell out their current investment structure and go to something, extremely conservative. So that inaction really tends to kind of go with Mike Napier's portion of the presentation, as well as, HORAN Capital advisors, that if you can ride this out through the long run, history has shown us that things tend to work out much better economically.
Well, and the key being, riding it out is one thing, but also use it to take advantage of the opportunities. Yeah. We wouldn't say just sit on your hands, but we would say take advantage of the opportunity that's presenting itself. Maybe you need to, if you're buying individual stocks, there's stocks that are trading at pretty good discounts today to where they were trading just a few months ago. And there's some segments of the market that look attractive, and you're getting an opportunity to make those changes here. Not that it's difficult to guess the bottom.
Well, David, I think you make a good point, and Matt probably can talk to this too, but it's a great time to dollar cost average in on your retirement plans, because it's an unprecedented opportunity to buy stocks at 30%, 25% off. No,
and that's a great point, and that's one way to start taking advantage of these lower prices. Don't put it all in at once. And another thing that's kind of rising to the surface is, if you're in a position where you're considering making a Roth conversion with stocks down here, your tax consequences of doing that are going to be lower. So you might have an opportunity to do that as well now too. It's something to look at and talk about with your advisors. Right.
Greg, you have some interesting. You had an interesting week with the life insurance industry, and I know you have a few stats.
I do. Thanks, Terry. I had a great call this week with the president of the ACLI, which is the American Council of Life Insurers. Just to kind of give you, I just want to give you a scope of what's going on in the life insurance industry and how strong the industry is even through this crisis. The ACLI represents 280 life insurance companies, which represent about 96% of the total industry. The scope of products that they cover are individual life insurance, disability, long-term care, and annuities, but they also have a presence in the group benefit business with group life, disability, and some other ancillary products. This group of companies serves over 90 million families in the United States. The benefits that they provide on a daily basis, this blew me away, is $2.1 billion per day. To put that into perspective, Social Security provides $2.7 billion a day in benefits. So the life insurance industry is a very, very large part of our economy. 11 million small businesses utilize life insurance for business protection needs. And, the takeaway from this whole phone call, Susan Neely, who's the president, basically said at the end of the presentation, the insurance companies couldn't be any sounder. They pack a very big wallet and are very financially sound for the future. So the takeaway, if you have questions or if you need anything on your life insurance policy as far as claims or benefits, these are companies are very good position to pay out those claims and benefits.
Great. Thanks, Greg. Appreciate that. Well, I think, are there any other questions we want to cover? No, I think we're going to wrap it up for the afternoon. I want to thank David and Michael, Matt, Paul, and Greg for being on here with me today. And we intend to host this seminar or webinar next Friday at 2 o'clock and ongoing until we get through this period of great uncertainty. Additionally, on Wednesday, April 8th, we are partnering with Lindsay Barnett, a partner at Graydon, Head & Ritchie, to host a webinar. More information to come on that. It will deal again with some deeper explanations of the CARES Act, I know. You can sign up for both these on our website, www.horanassociates.com. And changes and updates occur daily, and we'll continue to strive to provide you with the legendary service that you come to expect from us. Thank you very much, and have a great afternoon.